Hi everyone, I'm Al Brooks, and I want to talk about what I think the stock market might do in the coming year. Last year totally overlapped 2021, and now 2023 is in the middle of last year's range. So we have 3 sideways years, and I think the year will end up mostly sideways. The yearly chart eventually is going to form a trading range. That means a couple legs down, a couple legs up, lasting about a decade. There's a 40% chance that last year is the start of that trading range. On the monthly chart, bear trends are rare. So even though we sold off for a year, I think trading range is more likely. So in conclusion, I'm expecting sideways in 2023, a trading range on the monthly chart, and a third consecutive sideways bar on the yearly chart. Yearly chart, as I said, so far sideways with the past 2 years. This is the cash index of the S&P, and it's a yearly chart, and that means every bar is 1 year. So this is 2022, and this is what we have so far in 2023. It's also a semi-log scale, because if I used a regular scaling, all of these bars would be compressed and you would not be able to see the patterns that took place. Now, why are you watching this video? Because you're looking for ideas. Everybody knows the Fed started changing its policy last year. For the past 10 years, the Fed would do things to prevent the market from falling more than 20 or 30% down, and therefore traders were aggressively buying all the sell-offs. And that's no longer the case, and nobody knows where the Fed put is now. It might be 50 or 60% down, and therefore the risk in the stock market is greater than what it has been. We have a lot of confusion, lots of reversals on the daily chart, a trend going down for a long time on the weekly chart. Confusion is a hallmark of a trading range. So when the market's in a trading range, traders are confident that the legs up and down will not continue forever. They're looking for reversals. So they buy low, they sell high, and they take quick profits. Now, it's normal for someone starting out to feel anxious and upset when the market is in a trading range. And if you're feeling that way, instead of being upset, you should view it as your radar telling you that the market is probably in a trading range. If that's the case, which it probably is, you have to trade it like it's in a trading range. You buy low, you sell high, and you take quick profits. Don't hold hoping that the market will continue up indefinitely. This is the yearly chart again. A semi-log scale, S&P. On television, everybody's talking about a recession, and some say the sell-off will go all the way down to the pandemic low, all the way down here. Others are saying that the October low will hold and that the bull trend is resuming and that will go up to a new high. Traders live in a 40-60 world. You should never be more than 60% confident of anything. Always assume that the opposite will happen at least 40% of the time. So when you see those guys and gals on television talking with absolute certainty that the market is going to do something, that is such baloney. You should totally ignore it. Remember, it's a market. There are always buyers and sellers, and there are always enough institutions willing to take the opposite side of any trade to keep the probability of the market going up or down X% within a 40 to 60% range. So what's the chance of it going up 10%, down 10%? What's the chance it'll go up 20% before it goes down 20%? The probability is always going to be between 40 and 60%. So therefore, never be more than 60% certain of anything. This is the monthly Dow Jones Industrial Average chart going back for 100 years. You can see patterns clearly here, but you don't see patterns well here. That's because this is normal scaling, not semi-log scaling. When you use normal scaling, you're thinking in terms of points or dollars made or lost. And you use normal scaling when you're looking at less than a few years worth of data, or if you're looking at 5-minute charts. Semi-log scaling means you're thinking in terms of percentage gains or loss. Is the market going to go up 10%? Is it going to go down 20%? If you have more than 5 years of data, you should switch to semi-log scaling, because otherwise everything far to the left, you can't see what's happening. It's useless, so you shouldn't even bother looking at it. When the recent price is 2 to 5 times greater than the lowest price on the chart, it's usually better to switch to a semi-log chart. And that's what I did here. This is a semi-log chart of the Dow, and you can now see the patterns that took place 100 years ago. This chart began around 1920 or so, and this was the Great Depression. A bear trend is a series of lower highs and lows. A bear market is a sell-off 20% from the high. And there's never been a bear trend on the yearly chart. Even when the market fell 89% in 1929, 1932, it was not a bear trend. It was one leg down and not a trend, a series of lower highs and lower lows. So bear market, yes. Bear trend, no. The yearly chart has never been in a bear trend. Fundamentals, well, there's one fundamental fact, and that is that the wealth of the world is increasing. We keep making more people, and we keep increasing productivity. So the total dollars in the world here is a far greater number than what it was back here. And that's going to continue throughout your lifetime. As long as we keep making more people and improving productivity, the world's wealth is going to continue to increase. Cash index, yearly chart. Each bar is 1 year, and this is semi-log scaling. Now, there are 64 bars on this chart. 46 of them are bull bars, and 18 of them are bear bars. And that means 72% of the bars are bull bars. And that's why when you watch TV at the end of the year and you see experts talking about what to expect next year, they're always bullish, because they know there's a 72% chance that the market will be up next year. Yearly chart. We're going to enter a trading range within the next few years. Over the past 3 years, the market's up 100%. So from this low to where we are now, it's more than 100%. This is the pandemic low, and this is the high. That's over 100% gain. Remember, this is semi-log chart, so that the recent prices are compressed compared to the earlier prices. Now, the stock market has an average gain of 8% a year. So on this chart, over the past 60 years, it's averaged 8% a year. Now, with it up 100% in 3 years and up many hundreds of percent over the past 10 years, it's going to have to go sideways to down for many years to get back to average. It'll have to do this. It'll have to do this. What we don't know is, has the trading range begun? Was last year the start of the range? I would say 40% chance the trading range has begun, and 60% chance we'll get at least one more leg up, maybe to above 5,000, before it's clearly in a trading range. Trading range, you're looking for at least a couple legs down, a couple legs up here, 1, 2, 3, and here several legs up and down. Bottom of the range will probably be 30 to 50% below the top of the range. Like here, down 50%, down 58%, and here there were several corrections of 30 and 40%. When the market's in a tight bull channel and it has 3 pushes, here 1 and then a bear bar, 2 and then a bear bar, and 3 and a bear bar, that's a type of a wedge. And when the channel is tight like this, I call it a parabolic wedge. And whenever you have any kind of a wedge, there's typically going to be some profit taking. It'll attract profit taking. And that usually results in a couple legs sideways to down. The minimum needed for 2 legs sideways to down is 3 bars. So down, and then sideways or up this year, and then next year sideways or down. So we're probably going to be sideways to down for another year. So this year and next year. Could be more. We could be in a trading range that could last a decade, but at a minimum, I'm expecting 2 legs sideways to down. So 1, and then pause or bounce, and then 2. So I expect next year to be sideways as well. The high that took place January last year came in a very unusual environment. The interest rates were basically zero, and the Fed was providing tremendous liquidity to the economy. The earnings that we had were enough in that environment to put the price up here. Corporations were paying virtually no interest, so all of their earnings, they get to keep all of their earnings. Price is always directly related to earnings. With the Fed basically printing money, corporations had to spend very little on interest, and that means they get to keep all of their earnings, and price is always some multiple of earnings, and if earnings are high, price is going to be high. But that's no longer the case because the Fed's no longer basically printing money. Therefore, corporations are going to have to start to pay higher interest rates, and that comes from their earnings, and that will reduce their earnings. And it might take several years for earnings to grow to the point where price back up here is justified. So that's why we're probably going to be sideways for a couple of years. And in fact, we might be sideways for a decade. Look at this bar. The high of the bar is above the high of that bar. The low of the bar is below the low of that bar. It's an outside down bar. And not only is it an outside down bar, it closed near the low of the bar, and more importantly, it closed below the low of the prior bar. So that close is below that low. And that's a sign of aggressive selling. And the bear body was bigger than the past 5 bars. So a bigger bear body, so more conviction. And it's also the third bar in the past 8 bars. So we're starting to get more selling pressure. And most of the bars are mostly overlapping. That combination increased the chances that the next year would be down, which it was. Compare that to last year. Again, an outside down bar. We went above the 2021 high, below the 2022 low, but the close is above the low of last year, and the close is well above the bottom. We have a fairly conspicuous tail. And the body is not especially big compared to these other bodies. That collection of facts means that this is a weaker reversal than what we had here, and that reduces the chances that we'll go much further down this year. So it's an unremarkable outside bar, and that has an increased chance of mostly sideways. And this year already is a third sideways bar. I have 2 trend lines drawn here. This one goes back 50 years. This one goes back about 10 or 15 years. The market tends to work its way down to bull trend lines. And it did that in 1987, although it's not all that evident. 1987 did pull back to a trend line. I think this is the 87 low. There's a trend line there. I don't have it drawn in. And it did that here as well. The 2009 low was at a trend line. If we draw a trend line across these lows, this was at a trend line. The market is going to come down to this bull trend line and to that bull trend line. I don't know if it'll come down to it this year or go sideways for 5 or 10 years, and then with the line going up, the market reaches it, and it probably will eventually get down to this trend line as well. This is around the pandemic low, but if the market were to go sideways for a few years, this would be up here in the middle of the pandemic range, 2,500, 2,700, something like that. So we may in fact reach this trend line. And when the market reaches a monthly trend line and reverses, it usually leads to a pretty good leg up. So I've got a trend line here, touched it, rallied strongly. And if I draw a trend line using these two lows, we reached it here, reversed up strongly. So if we get down here and get a reversal up, it'll probably go higher for several bars. If we get a reversal here, we'll probably go higher for a lot of bars, 10 or 20 bars, like that or like that. And we can get there by going down or by going sideways. This trend line is around 2,700, and that's within reach. We might get there this year. But this 50-year trend line, it might take a decade or more to get there. Monthly chart, bear trends are rare. This is a monthly chart of the S&P. There have been many, many reversal attempts, but only 4 bear trends. It's hard to see, but a series of lower highs and lower lows, that constitutes a bear trend. 87 crash, the market fell more than 20% in one day without first transitioning into a bear trend. Usually, if the market is going to transition from a bull trend to a bear trend, it has to first evolve into a trading range. So bull trend, sideways, and then down. Bull trend, sideways, then down. Bull trend, sideways, down. Bull trend, sideways, down. Bull trend. We're starting to go sideways, but we'll probably have to go more sideways before we can get any kind of a big sell-off. Again, monthly chart, so we may have to go sideways all year. Lots of reversal attempts, but they become bull flags. The bull trend resumes. So only 4 bear trends on the monthly chart in the past 50 years, 60 years, and lots of attempts to get bear trends, but they were all brief, and we never got a bear trend. It became a pullback, and the market resumed up. So bear trends are rare. Is this the start of a bear trend? Probably not, because bear trends are rare. Here's a close-up of the monthly chart. And look at this rally that took place from the pandemic low. You see consecutive bull bars here, consecutive bull bars here, closing near their highs, decent-sized bull bodies, and it's happening repeatedly. If you're a bear and you sold at this high and sold more higher, you lost money. So bears are not making money with limit orders. This is all evidence of a strong bull trend. Now compare that to the bear trend that we've had, lower high, lower high. We've only had one pair of consecutive decent-sized bear bars, and we've had lots of bars that were bad follow-through, big tail bull bars. Many sideways bars. There's no lack of urgency. Limit order bulls, if a bull bought that low and bought more lower, he made money. If he bought that low, he made money. If he bought that low, he made money. So bulls are making money in a bear trend. So all of these factors make this a weak bear trend. It could always become a strong bear trend, but so far it's a weak bear trend. Now I want to show something else. Here's the cash index and here's the E-mini, the futures contract. And here's a 50% correction of the move. We had a strong reversal up from just above a 50% correction on the E-mini. But on the cash index, this is the same as this. The cash index did fall to just below 50%. And you can look at that and say, oh, that's a divergence. That's a sign of strength. It could also be a sign of weakness. Traders might look at this and say, it didn't fully reach 50%, and therefore it did not adequately test 50%, and it probably is going to have to come down and hit 50%. So just because we have divergence does not mean that the futures contract is stronger and it's going to go up. It could be that it has not gone down far enough, and traders think it has to get below this line before it can go much higher. Uncertain, that increases the chances of a sideways market. Here we had an outside down bar followed by an outside up bar. And then here we had an outside up bar followed by an outside down bar. So on the monthly chart, we have a lot of reversals taking place, and that generates confusion. And as I said, confusion usually leads to a trading range. We also have a micro wedge, 3 legs up, and then a bear bar, up and then a bear bar, up and then a bear bar. And you'd expect at least a couple legs down, 1, pullback, 2. In fact, we've had several legs down. So we've met the minimum expectation for the bears. But now we have a micro wedge on the bottom, down and up, down and up, down and up. And traders are expecting at least a couple legs sideways to up. We have 1 pullback and we're forming 2. We could get several and it could keep going higher. But I suspect that this is going to stall somewhere in the middle and we'll have another test down. The bulls want a strong breakout above the August high and then a new high. But I think there's only a 40% chance that we're going to keep going straight up to a high far above this high. It might go a little bit above it, but I don't think that this is a resumption of this. I think it's a continuation of this. So I think we'll get a rally that looks like this, not all that strong, and I think we'll get another leg sideways to down. A wedge means 3 failed attempts to continue the trend. Bulls typically take profits and expect a couple legs down for a wedge top, and for a wedge bottom, bears take profits and expect a couple legs sideways to up. And as a guideline, a correction from a wedge usually lasts about half as many bars as in the wedge or as in the rally. And we've had about half as many bars as we had in that entire rally. 10 bars down, so we'll probably get at least 5 bars sideways to up. This is disappointing to the bulls, and they might conclude that the first leg up is going to fail, which is what I think. I don't know where it'll fail. It could go above that. It could fail on this bar. We could suddenly reverse down. But I do think this is a bull leg in a trading range, and that this is a bear leg in what will become a trading range. Second leg up. So I think this rally is a pullback from a first leg down, and that we'll get a second leg down before the bulls have a chance of resuming the bull trend. As I said, this second leg up could end this month and just be more sideways and then go down. It could go above this, it could go all the way up here and then go down. But I think whatever rally we get will end up as a bull leg in what will become a trading range. After a second leg down, we will not necessarily go up to a new high. We could go sideways here for several years before we get to a new high. But at a minimum, I think we're going to go up and then get a second leg down. And I do think we're going to go below the October low. I do think we're going to go below the pre-pandemic high. In other words, below 3,300, 3,200. Weekly chart, I want to make one point about the weekly chart, and that is this. We had a trend, and it paused at every big round number, 2,500, 2,600, 2,700, 3,500. Except here, it accelerated up above 4,000. There was a gap on the weekly chart, there was a gap on the monthly chart, there was a gap on the daily chart, all around 4,000. So clearly a very important price. And last year I said I thought this year would come down and close all those gaps, which we did. We've been going sideways here around 4,000 now for 9 months, again validating how important this price is. The all-time high is important, and now we have another important price, 4,000. When you have 2 important prices, they often create a third important price, a measured move down. And here's a measured move from the all-time high to 4,000. And it's below the pre-pandemic high. And I think there's better than a 50-50 chance we're going to get there at some point this year. Other targets for the bears, whether or not we go higher before we go down, the pre-pandemic high. Many stocks have already fallen below their pre-pandemic highs. That's down 31% from this high. On the E-mini, we have that 50% pullback. That's a magnet. I think we're going to get below it, and I think we're going to get below this. And I think there's a 50% chance we're going to get all the way down to a measured move from the high to 4,000 down here. So I think there's a 50% chance or more that we're coming down here. Probably this year, possibly next year. Markets often pull back to the middle of a triangle, and this is a backwards triangle. Instead of a contracting triangle, it's an expanding triangle, but it's still a triangle, an area of agreement that the price is fair. And the markets often come back to the middle of a triangle, which is around 2,700. I don't know that we'll get that far down. And markets sometimes come all the way back to the bottom of a buy climax. This is 56% below that. And right now, I think there's only a 20% chance that we're coming down here. Ever. I think only a 20% chance we'll ever get to this low. Obviously, if we start to sell off strongly, instead of 20%, it becomes 30, 40, 50, 60%. But right now, there's only a 20% chance that the stock market will ever get back here again. My conclusion, as I said, sideways in 2023. I want to summarize what I've been talking about. All trends eventually evolve into trading ranges. On the monthly chart, we've had several small legs down, but bad follow-through on the way down. This is a trend. We have lower highs and we have lower lows, but it's not nearly as strong as the bull trend was here, as I said earlier. This is probably a bear leg in a trading range. The sell-off is deep enough so that traders are wondering if a trading range has begun. Remember, a trading range has at least a couple legs sideways to down, and the legs tend to be several bars long. A trading range is usually at least 10 to 20 bars long. I refer to this as a trading range instead of a bull flag because I think traders believe the first rally will be sold and we'll get at least a small second leg sideways to down. Bulls who bought anywhere up in here are disappointed and surprised by how many bars the sell-off lasted on the monthly chart and how deep the market retraced. And therefore, a lot of these bulls are thinking the market is transitioning into a trading range. They don't know if this is the end or if it'll go down lower. In any case, a lot of these bulls will look to sell if the market gets back to where they originally bought. They want to try to get out around break even. So you have bulls selling at the high, not bulls buying at the high. There are bulls who are going to be buying at the high, but there will be many who will be selling, and that will result in a second leg sideways or down. On the yearly chart, 2022 is a big bear outside down year. It's a pullback in a bull trend. However, because it's a big bear bar closing below its midpoint, and because it's upside down and it's a third leg up, a parabolic wedge, and this has gone on a long time, it's not a very good buy signal bar. Normally in a pullback, traders buy above the high of the pullback bar. There'll be more sellers than buyers above last year's high, so we probably will not go up very much in the next couple of years. On the other hand, we have about a dozen bars in a very tight bull channel with mostly bull bars closing near their highs. That reduces the chance that we'll get much of a sell-off. So there'll be buyers not far below last year's low. So if traders are willing to buy down here and sell up here, it increases the chances that we'll be sideways this year, and I suspect we'll be sideways next year as well. 40% chance the yearly chart has transitioned into a trading range like we had here and like we had here. 60% chance we'll go at least up for a few more bars before the transition begins. We have a micro wedge top. It's a wedge on the daily chart, but on the monthly chart, it's a micro wedge, and it's probably leading to a minor reversal, not much of a bear trend. As I said, bear trend, but not very strong, and it's less strong than this. However, it's strong enough so traders will expect at least a small second leg sideways to down. there's better than a 50% chance we're going to get down to this level. This is based upon the March contract. If we don't get there by March, the June price will be different. The key is a measured move from the all-time high, an important price, and 4,000, an important price. So I suspect we'll get down here, which is just below the pre-pandemic high. I think better than a 50-50 chance we'll get there. I think the worst case is that the sell-off will get back down to the middle of this expanding triangle. What's the chance that we get back down here? This is almost 60% down from the high. I think it's 56% down from the high. At this point, I think maybe a 20% chance we get there. And if we go up to a new high, maybe the chance of ever getting back down there will be 10%. In other words, we may get near it, but I don't think we'll get below it. No sign of a major top. We should evolve into a trading range lasting 5 to 10 years, 5 to 10 bars, maybe more. And it should begin within the next several years. But right now, there's a 40% chance that the trading range has already begun. 2022 was a bad buy signal bar, so sellers above, buyers below, probably sideways for at least 2023, and I suspect mostly sideways for 2024 as well. 3 consecutive bear bars, unusual. I think that's the first time we've had it in 60 years or so. So I doubt we'll have a big sell-off down to the pre-pandemic low. But as I said, we may get a second down year, and then we may do something like this over the next several years. I know it's not a spectacular call in this video. Everybody wants to hear, oh, the market's going to go up big next year, or the market's going to go down big next year. But that's not the case. I think this is going to be more like this kind of stuff or this kind of stuff, and not like the majority of the bars on the chart where the market trended strongly up. Again, yearly chart, probably mostly sideways this year and probably next year as well. However, I also think the market will develop into a trading range with a couple obvious legs down and up within the next few years, and it probably will last a decade. Monthly chart bear trends are rare, so even though we've sold off a lot, I think we're going to be sideways for the remainder of the year. And I think there's better than a 50-50 chance that we're going to get down to that measured move based upon the all-time high and 4,000. Again, I'm Al Brooks. I hope that you found this helpful, and I hope that you have a good year.